Welcome to Talk Tickers, your shortcut to being truly well-informed. Today, we're diving deep into an earnings call that has everyone buzzing. Advance Auto Parts and their second quarter 2025 results. This isn't just about numbers, though. It's a really fascinating look at a company sort of in the thick of a multi-year turnaround. We're going to unpack their financial performance, their strategic moves, and crucially, the market's rather, strong and immediate reactions. So let's get right into it.
That's right. Advance Auto Parts, AAP, they just wrapped their Q2 earnings call, and the numbers, they reveal a complex, almost paradoxical picture. They posted a beat on adjusted earnings per share, but the market responded with a pretty significant downturn after their guidance update. Understanding the sharp divergence between, management's story of progress and what investors are actually feeling is absolutely key to grasping what's truly going on here. We'll guide you through the pivotal financial figures and the strategic actions shaping their future, always keeping that sort of tension in mind.
Okay, so the big question after any earnings call is always, what do the numbers actually tell us? Let's maybe kick things off by breaking down those headline figures. Revenue first.
Sure. So revenue came in between $2 billion and $2.01 billion.
Okay.
Now that's roughly an 8% decline year over year, which sounds bad, but it was actually modestly above what forecasts were expecting.
A slight beat on revenue then, despite the drop. Okay. What about earnings per share, the GAAP number?
Right. The GAAP diluted EPS, that's the standard accounting figure, was $1.25.
For 25 cents.
Yeah, and that's down from 251 cents a year ago. So pretty steep drop on that standard measure.
But here's where it gets really interesting, right? The non-GAAP, the adjusted EPS number.
Exactly. That adjusted figure, which, pulls out certain one-time items to show core performance, that was 69 cents.
69 cents. And the street was expecting?
Consensus was around 75 to 76, so it beat estimates by about 13 cents. A decent beat, actually.
Okay, so an adjusted beat. But what about cash? Was the cash flow looking good?
Well, that's the other side of the coin. Free cash flow was negative. Negative $201 million year to date. So they're burning through cash.
Oof. Not great. And comparable store sales, that key health metric.
Just barely positive. A tiny increase. 0.1%, so essentially flat. What's truly insightful here isn't just the numbers themselves, but the story they immediately tell. On one hand, management squeezed out that adjusted EPS beat, maybe showing some operational discipline, but on the other hand, you've got declining revenue, you're burning cash, and sales at existing stores are basically flat. It paints this picture of a company pushing really hard for that turnaround, but while still bleeding cash and barely growing sales on a like-for-like basis.
Right, even with that adjusted EPS win.
Exactly. And the market's immediate reaction, that sharp share price drop, signals investors were looking past the beat. They were weighing those other factors like the negative cash flow, the flat comps, and especially the forward outlook and the debt situation much more heavily.
It really is that classic messy middle of a turnaround, isn't it? You've perfectly captured that tension. So despite the adjusted beat, the revenue dip and negative cash flows show they're still deep in the trenches. Given all that, what did management really emphasize? What were their key themes? What's the narrative they're pushing?
Well, management, led by CEO Shan O'Kelly, they were keen to frame Q2 as a return to profitability. A significant milestone, they called it. They pointed to the store footprint optimization, other strategic moves. And they really emphasized the continued strength in their pro business. Selling to mechanics and garages, that saw positive comparable growth.
Okay, so pro is still a bright spot.
Seems to be. And they also mentioned emerging signs of stabilization in the DIY segment. That's the do-it-yourself folks. Comps there were apparently consistent with Q1, maybe improving a bit on a 2-year view. They even said that momentum carried into early Q3.
Okay, so some positive signals, at least according to them. This turnaround plan, though, it sounds like a massive effort. What are the core pillars?
It is huge. They're executing a 3-year plan, really built on 3 main things. First, selling off Worldpac, which they did earlier this year to streamline things.
Right, the divestiture.
And second, rationalizing their stores and distribution centers, basically optimizing their physical footprint. And third, proactively refinancing their balance sheet, trying to get their financial house in order for the long haul.
Okay. Beyond the big financial stuff, they also talked a lot about operations. I was intrigued by this AI-enabled assortment framework. What exactly is that?
Yeah, that's it's pretty interesting. It uses AI, advanced tech, to basically get smarter about their inventory. It helps them enhance parts coverage and really tailor what's in stock to the specific needs of each local market, each DMA as they call it.
So making sure the right part is actually in the store when someone needs it.
Pretty much.
Yeah.
And they're rolling it out fast. Add another 19 DMAs in Q2, bringing the total to their top 30. The goal is to hit the top 50 DMAs, which is like 70% of their sales, by the end of Q3. And they said that's actually ahead of schedule.
Okay, ahead of schedule is good. But are they seeing results yet, or is it too soon?
They are seeing initial results from the areas where it's been in place longer. They're talking about like 100 basis point improvement. That's 1 full percent in having the part available at the store level.
That sounds significant.
It is, and an average comparable sales lift of about 50 basis points, so a 0.5% boost to sales in those stores.
But how quickly does that actually show up for investors, especially when the stock just took a hit?
Well, that's the catch, isn't it? Management themselves said they expect the full benefits over like 12 to 18 months. It's because auto parts inventory turns over slowly. These aren't T-shirts. Parts sit on shelves longer.
Ah, right. So it's a foundational fix, but not a quick win on the P&L.
Exactly. It underscores the patience investors might need here, which, given the market reaction, seems to be in short supply.
Makes sense. What about the rest of the supply chain? They mentioned distribution centers and these new market hubs. Any quicker wins there?
Yeah, seems like it. They've closed or converted 9 DCs already this year in the U.S. They're on track for 12 closures by year-end, bringing the total DCs closed to 16. It's a big streamlining effort.
Getting leaner.
Definitely. And reducing shipment errors, too. You see, those are down by about a third in the last 6 months, which is pretty good. And these market hubs, they're a new, really important part of their supply network. Think of it like a mini warehouse serving a bunch of stores.
Okay.
Each hub carries a huge number of parts. 75,000 to 85,000 SKUs. The idea is to expand same-day availability for maybe 60 to 90 stores nearby.
Wow, that's a lot of coverage.
It is. They opened 3 new ones in Q2, 2 of them greenfield, totally new builds. The plan is 10 this year, aiming for 60 hubs total by mid-2027. And these hubs are expected to drive, on average, another 100 basis points of comp sales uplift. So another full percent.
That's a huge investment. And speaking of investment, what about the stores themselves? I remember hearing they had a lot of deferred maintenance, like things were falling apart.
You remember correctly. They used to operate on what they called a break-fix model. Basically, wait till something breaks and fix it.
Been ideal.
Not at all. It led to this really aging infrastructure. Get this. 80% of their HVAC systems, over half their roofs and parking lots, were technically beyond their useful life.
Yikes. That sounds bad for customers and employees.
Exactly. So now they're seriously ramping up investment. Year to date in Q2, they spent about 3 times more on store maintenance CapEx than in all of 2024.
Wow.
It's gone into major upgrades at over 1,000 stores already this year, compared to just 400 stores touched in all of last year. It's a multi-year plan to eventually fix up all the stores. Essential stuff, but again, costs money up front.
Okay, so they're fixing the foundations, literally. How did the actual business segments, Pro and DIY, perform this quarter amidst all this?
The Pro business, serving the mechanics, kept growing. Low single-digit comp growth, sequential improvement. Seems like the initiatives are helping the AI assortment, faster service times.
So Pro is solid.
Relatively solid, yeah. The DIY side, though, it's more mixed. They use the phrase emerging signs of stabilization, consistent with Q1, better on 2-year stack. But management sounded noticeably cautious.
Cautious why? Prices.
Yeah, they're watching consumer behavior closely, especially with higher prices out there. They're focusing on training staff, pushing free services like battery tests, light scanning, trying to add value.
Trying to keep the DIY customer engaged.
Right. But the tone was definitely one of, let's say, careful optimism, not outright confidence on DIY.
Got it. Okay, let's shift gears to that big financial move, the debt restructuring. This hit their guidance, right? Tell us about that.
Yeah, it was significant. In early August, they did a big debt offering, $1.95 billion in senior notes, due way out in 2030 and 2033. They also set up a new $1 billion asset-backed credit line, secured by inventory and such, replacing an older one.
And what did they do with that money?
Mostly used it to pay off $300 million of older notes that were coming due sooner in 2026. Management said it was all about boosting liquidity, refinancing, supporting their financing programs, just getting more financial flexibility.
Oh, okay.
They're calling it a bridge structure. The idea is this helps them now. And the long-term goal is to get back to an investment-grade credit rating.
Like cleaning up your credit before applying for a mortgage?
Kind of, yeah. Better, cheaper financing down the road is the hope.
Yeah.
But, and this is the crucial part for Q2, this new structure means higher interest expense now.
Ah, there's the rub. Okay. And what about tariff that's always hanging over retailers? How's that hitting them?
It's definitely a factor. Management said about 40% of their cost of goods is exposed to tariffs at a blended rate of around 30%.
That's quite a bit.
It is. And they expect a more pronounced impact in the second half of this year, 2025. So their strategy is, well, kind of multifaceted. Measured price increases, negotiating hard with vendors, looking for alternative suppliers, maybe different countries of origin.
Trying to offset the costs.
That's exactly. And optimizing promotions. They think more benefit from that will come in 2026. They did note the industry tends to be pretty rational about passing on costs, so they expect competitors will raise prices too, which helps cushion the blow a bit, but it's still a headwind.
Definitely another layer of complexity for this turnaround. Okay, so summing up Q2, lots of operational moves, some progress, but also financial pressures. What does this mean for the rest of 2025 and beyond? What's the guidance look like now?
Well, for the full year 2025, they actually reaffirmed most of their previous guidance. Net sales still expected between $8.4 and $8.6 billion. Comp store sales growth 0.5% to 1.5%. Adjusted operating margin 2% to 3%, though they expect Q3 to be higher, above 4%.
Okay, so mostly steady there, but free cash flow, still negative.
Still negative, yes. The projection is now between minus $85 million and minus $25 million for the full year, still burning cash, which investors obviously don't like.
Right, and the big change was the EPS guidance.
That was the headline grabber. They lowered the adjusted diluted EPS guidance range to $1.28, $2.20. That's down from the prior range of $1.50, $2.50.
And that drop was mostly due to?
Primarily attributed to the higher interest expense from that debt refinancing we just talked about. They estimated it had about $1.30 negative impact on EPS.
Okay, so that higher interest cost flows right through to the bottom line guidance. And what about longer term? Are they sticking to their 2027 goals?
They are. They reaffirmed those fiscal 2027 targets, low single-digit comp growth, adjusted operating margin around 7%, and getting that debt leverage ratio down to about 2 to 2.5 times, working towards regaining that investment grade rating.
So the long-term story is intact, in their view?
In their view, yes. But the market's reaction tells a different story, doesn't it? Despite the Q2 adjusted EPS beat, the stock got hammered, down like 7.8% pre-market, then plunged about 15% during the day.
15%, wow.
Yeah. It signals loud and clear that investors, right now, are way more sensitive to that near-term earnings guidance cut and the high debt levels than they are impressed by the operational traction management is highlighting.
It's tough when you've lagged your peers too, right? Like AutoZone and O'Reilly.
Absolutely. AAP's value is down nearly 75% over 3 years, massively underperforming those guys. Though, the whole industry does benefit from that structural tailwind, older cars on the road needing more non-discretionary repairs. That backdrop is still favorable.
True. Okay, well, it's time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on everything we've just discussed. And remember, folks, this is strictly for entertainment and discussion.
Exactly. Please always do your own homework. Talk to a financial professional. Don't trade based on a podcast segment. Yeah.
Couldn't have said it better myself. Okay, with that vital disclaimer locked in, here's my thought, hot off the press from today's call. How about a short position on Advance Auto Parts, AAP equity, paired with a long position in maybe a highly liquid, short-dated corporate bond fund? My thinking is this. Management themselves sounded cautious about the DIY customer dealing with higher prices in the second half. They used phrases like evolving landscape, nonlinear benefits from their fixes. The market's brutal 15% drop tells you investors heard that caution loud and clear. Despite the EPS beat, the lowered full-year guidance because of interest costs, plus ongoing tariff worries, plus that shaky DIY outlook, it feels like profitability pressure isn't going away soon. That bridge structure to get investment grade back by 2027, that's a long time away in market terms. Investors might keep punishing any short-term slip-ups no matter how much long-term strategic progress they make. So the short AAP position tries to capture that near-term skepticism and pressure. The bond fund, that's sort of a hedge, parking cash somewhere relatively safe while we see if the AAP specific headwinds play out. It feels outrageous because it flies in the face of management saying, return to profitability, solid Q2. But it feels plausible because it leans right into the specific worries they mention and the market's immediate, very negative vote.
That's a bold take, definitely. It really crystallizes that disconnect we've been talking about. The market's immediate skepticism versus the company's longer-term story captures that divergence perfectly.
And that brings us to the end of our deep dive into Advance Auto Parts Q2 2025 earnings call. We've seen a company working really hard on a very complex turnaround, some genuine operational wins, the AI assortment, supply chain improvements, but also facing pretty significant near-term pressures, tariffs, consumer behavior worries that are clearly impacting their earnings outlook right now.
Yeah, and the story of Advance Auto Parts is just such a compelling reminder that in the world of earnings, a headline beat doesn't always mean the market throws a party. Understanding that nuance, that gap between operational progress that takes time and the forward-looking guidance that gets hit now by things like interest rates,
Yeah.
especially during a big turnaround and with debt restructuring. That's just paramount.
Absolutely. So, as you think about what this all means for your own understanding of the auto parts sector, maybe here's a thought to chew on. How long will the market keep prioritizing these immediate financial impacts, the leverage concerns, over the foundational, maybe slower burn, but potentially crucial operational improvements that management seems so confident about? Where does that balance shift? Thank you for joining us for this deep dive. If you want to keep exploring the intricacies of corporate financials and market reactions, keep tuning into Talk Tickers.